Hi, folks. This is Big Mike Zlatnik, and today we're going to talk about real estate syndications. This is a short executive summary overview of syndications. Obviously, there's a lot more to it, but I wanted to give folks the basic framework for real estate syndications, how they work, what are the benefits, and so on and so forth. So typically, real estate syndications are a form of real estate partnership where a general partner, a sponsor, or an operator needs to raise capital for a transaction. It could be multifamily, it could be self-storage, could be office, and so on. And the investors are limited partners. They're participating as passive investors in the deal, providing capital to the operator. And the operator typically is the manager of the transaction. So the benefits to the investors are that they get to take advantage of the expertise, track record, history, and abilities of the sponsor. They invest passively. They can generate passive income in the form of cash flow. They could also benefit from the tax benefits such as depreciation. And investors don't get to spend time lining up a mortgage. So that's the beauty about syndications. They pretty much participate in a baked product. They just subscribe. Obviously, they need to review and make sure it meets their risk and other goals or objectives and risk tolerance. On the other side, for the operator or the sponsor, they raise the capital from investors, and they only need to bring in typically 5 to 10% of the total capital required for the deal, and the rest of the money comes from the investors. Most of the syndications are done on the equity side when there is a ready-to-go mortgage lined up with a bank. So what kind of mortgages typically are available? These are commercial products, and they're typically non-recourse mortgages. So the sponsor or the operator doesn't personally guarantee the loan. Nonetheless, they have expertise, track record, and a value-add plan that the bank is comfortable to provide financing. So normally, the bank would finance 70% of the total capital needed, and investors would bring in 30%, sometimes 75-25, depends. So syndication is a form of partnership that raises the capital for the deal, with the general partner running the transaction, executing the value-add plan, and investors participating as limited partners or passive investors. As I mentioned, the benefits, now we're going to talk about the how these syndications take place. So normally, from a process perspective, a sponsor gets a property under contract. Let's use an example of a multifamily. They get the property under contract, they underwrite the deal, they are comfortable with the deal themselves, with the economics, with the value add strategy, with the economic projections, and that is part of the underwriting package. Typically, a sponsor or an operator builds what is known as a pro forma spreadsheet, where they project rent increases, renovation costs, projected cash flows, ability to pay the debt, and so on and so forth. All that data is typically available to investors to review prior to making the investment decision. So once the deal is underwritten, baked, it gets presented to the bank. The bank typically underwrites the deal on their side, and when they're comfortable, they'll approve the loan, subject to the investor raising a certain amount of capital, and that's required capital. And that's what the sponsor needs to be able to complete the deal. So they go to investors, they typically create an offering memorandum or a private placement memorandum, also known as the PPM. So the offering memorandum is created by attorneys with a bunch of legal disclosures, with a bunch of projections, deal explanation, deal details. Effectively, that document is the formal offering document to investors. So investors review the PPM or OM, offering memorandum, and make a decision whether they want to participate or not based on their own objective, their conversation with their attorney or CPA professional. As long as this type of a deal meets their objectives, meets their level of comfort, risk tolerance, they may consider that investment. Now, let's talk a little bit about risks and rewards of investing in a syndication. So first of all, when an investor, who is also known as a limited partner, takes a position in syndication, So let's just use an example as a $5 million syndication, and then they write a $100,000 check. They take a small piece of ownership, they get the benefits, they get the cash flow, the depreciation. At the same time, they take in some level of risk as a partner in the deal. The risk could be that the deal could go bad. Just to be very clear, there's always risk involved. Syndications, even the best looking syndications on paper, well underwritten, well prepared for, can go wrong. So I just want to make sure folks understand that there's risk in everything. But a well underwritten syndication could also generate strong returns. Quite often, the returns on a syndication, on a value-add syndication in real estate, could look like target returns, could be, let's just say, between 15 and 25% IRR. IRR stands for internal rate of return. The best way to think about the IRR, it is a compounded average annual ROI, because IRR formula, internal rate of return formula in Excel, takes into consideration when the cash goes in the deal and when the cash comes out in the form of cash flow, in the form of a sale proceeds as well. So typical rate of return on syndications, depending on the market, could easily be in the mid to high teens, could be even in the low to mid 20s. Now, it all depends on the type of deal, the risk profile, the value add strategy. So investors need to be cognizant of the fact that there are risks and there are different types of risks, and understanding the fact that it is still a single deal. Typically, syndication is for one asset, many investors. Sometimes syndications could have two assets, but if there are many assets in the syndication, it becomes a fund. So fund, comparing fund to syndication, fund has many investments, many assets, and many investors. Syndication has typically one asset, many investors. This is the basic comparison. So from a risk profile, if you compare a fund to a syndication, the fund spreads the risk among many investments, many assets, while syndication concentrates the risk in a single property. If that property value add plan is successful, syndication can be successful. If the plan fails, syndication can fail. So as far as the structure of syndication, there are various structures, but the most common structure I'm just going to cover generates preferred return to investors. So an example would be a syndication offering documents could say investors will receive 8% cumulative non-compounded pref, means 8% accumulates every year. There's cash flow to pay that, it gets paid. If there is no cash flow to pay that in full, it gets accumulated, but it doesn't compound. So year one, it could be 8%, accumulated year two is 8 plus 8 becomes 16, and so on until there's a sale or a refi event. So 8% preferred return is a common number. Sometimes this number is higher, sometimes that number is lower. But the industry average kind of gravitates around 8% per year. Then there is a return of capital. Typically from a safety perspective, investors get paid their pref, then the return of capital, and it happens most of the time on a sale of the property. Sometimes return of capital could happen on a refi or a partial return of capital. Let's use an example of a sale of the property. So the pref gets paid to investors, then the return of capital takes place, and after that, there is a performance split. So there's a split between the investors as a group and the manager or the syndicator or the sponsor. And the typical split, just give you a classic example, would be a 70-30, 70% to investors, 30% to a manager. That's a classic split. And that's just the basic framework how these syndications work. So on a sale of the property, once investors are paid their pref and return of capital, split takes place. Investors get a portion of the upside, and the sponsor or operator gets the 30% performance fee for executing the project well. That's the general framework on how these deals are structured. There are many elements to syndication, but one of the most important elements is the value add plan. And depending on the type of asset, sometimes a value add plan means just buying land and building ground up. Could be a self-storage facility or industrial property or multifamily asset. Or a value add plan could be buying an existing multifamily complex, renovating units, improving common facilities, improving the clubhouse, and increasing rents as a result of the value add work, as a result of improvements to the property. And that's what creates higher rents, creates higher income, and increases the value of the property. It's very important to understand the operator and the sponsor. Who is the leader? Who is the expert? Who's going to execute the strategy? Strong sponsors generally have the abilities and the experience and the track record to execute well. One of the most important elements in underwriting and reviewing a syndication is knowing, liking, and trusting the operator and the sponsor. There's no easy way to do this. Sometimes it takes years to build that know, like, and trust. But in my opinion, that is a critical element in the underwriting, in your investment decisions, is to know, like, and trust the folks you're investing with. The person, their team, their communication, their ability ahead of the project themselves. Because if you go with the wrong person, if you invest, you can invest with an idiot, you can invest with a shyster, right? You can invest with someone who is not able to execute. So the critical component is who ahead of the what. Once you're comfortable with who you're investing with, then you look at what the deal looks like, the what. And once you're comfortable with that point you decide how much capital it is prudent to invest in this deal. Diversification is a critical element of one's investment decision. So as folks decide where to put their capital, it's critical for folks to understand that syndication is a single asset deal, and the deal can go badly or the deal can go great. And you have to be comfortable with the risk and tolerance for the concentration of the capital, whatever you have, whatever portion of your portfolio you have in that single deal. In comparison to the funds, as I mentioned, you could choose to invest 10% of your portfolio in a single fund and be very comfortable with that because the fund diversifies the risk among many assets. But putting 10% of your portfolio into a single asset, as an example, may be too high of a risk concentration. So something to consider. Risk tolerance depends on individual, their age, their financial situation. Obviously, consult with your real estate professional or your CPA professional or your attorney professional. But this is just a general overview how syndications work. I appreciate your time and attention. Looking forward to speak with you soon again on the next topic. This is purely for informational, educational purposes, not a solicitation of any comment of any kind.